Today we'll be talking about structural inflation and other small updates. Again, none of these are professional investment advice. Please do your own research and contact your own professional financial planner. So first we'll continue a continuing topic, which is stagflation versus hyperinflation, and why I think we're looking at stagflation and we won't see hyperinflation, more because of the labor productivity part, and also um, where there's no real supply chain issues for the long term. Then I'll talk about how where the structural inflation is now taking over from the transitory inflation going forward. And we'll talk about a hot topic so far of China cutting power and also the US debt ceiling. And then we'll talk about going long-term wise, the opposing mindsets in different central banks. And finally, we'll end up with market and commodities update. So first up, let's talk about stagflation versus hyperinflation. So stagflation, the definition is rising unemployment along with inflation, which is one of the incidents that prove the Phillips curve, which is showing the inverse relationship between unemployment and inflation to just be utterly ridiculous. I guess it works sometimes, just not in a stagflation period, which is something we saw in the 1970s in US. And as mentioned before, the reason why I expect this is happening or going to happen going forward is because labor participation rate is falling, and a lot more of that builds into the labor productivity, where when your productivity can't increase, but wages are sticky, so it doesn't come down as easy. And so what happens is you can't pay more, because if you pay any more, that unit of labor is not generating the same value, so you're losing money. But so if productivity can't increase and wages can't come down, what you have is a stagnant pressure on costs, because again, you can't pay that person more because you're losing money, but that person can't produce more either because the productivity isn't increasing. And what we're seeing is a few reasons where unemployment benefits have been generous, so a lot of people have not been working. So like I've discussed this before, the labor participation rate is it represents a big chunk amount of people not willing to work in the US. And there's also a wave of early retirement with the comfort seeing with baby boomers seeing like their real estate prices have gone up significantly, and their financial asset portfolio wise prices have gone up significantly. And so they realize they can afford this early retirement, anticipating that these prices will remain at these levels. Or maybe they just sold their home at this, great timing. Either way, so there's a lot of early retirement. So what happens is they bring a lot of expertise and productivity that is now lost from the economy. And maybe they come back, maybe they won't. And finally, there's a growing amount of younger generation participating in financial assets trading rather than actually working, or at least maybe not working full time. And so what happens is they're not building the skills and experience that they otherwise can translate into more productivity, higher wages going forward, but rather, they're there's more increasing amount of retail investors who, for long term, don't know what they're doing. And finally, I'll talk about some inflation pressures from structurally, which I'll discuss in the next slide, where we talked about the falling productivity, and then now we'll talk about the other inflation pressures. And now let's talk about why I don't think hyperinflation would be coming, because so for the definition is 50% increase in prices for monthly. And the reason for that is you need a strong supply constraint for that to happen. And one of the examples is, Weimar Republic, Germany. And why I don't anticipate that is because I don't think trade relations will occur on a global, like trade relations will break on a global basis, and meaning like, China won't just completely cut off trading with the rest of the world. So I don't anticipate that to happen. Now let's talk about structural inflation and transitory inflation. So transitory inflation have been thrown around a lot from various central bank leaders, with Jerome Powell representing the Fed using it, quite often. And now they're actually trying to, sway away from it. And honestly, I think it was just an excuse to cover up their easing monetary policies. And therefore, I think, once people realize that inflation is here to stay, then um, they'll act much more differently. And why is that? So if we look at structural inflation, at least the kind of ideas and kind of pressures that I'm seeing is, again, one is labor productivity, because if labor productivity can't go up, but wages are sticky, coming down, and therefore you have the stagflation pressure on that end. Next, we have the carbon neutral initiatives, where we're pushing for more lower carbon emission energy, but at the same time, the reluctantness of moving, increasing more development into nuclear means they're trying to rely a lot of it based on, solar, wind, and the issue with that is, as a secondary energy source, they can't replace a primary in terms of reliability and efficiency. And so what happens is now we're seeing in Europe is that they're increasing the need of natural gas with winter approaching. And that's why their energy prices are soaring, because of lack of long-term capital reinvestment in fossil fuel plants, and not willing to invest into nuclear. And they invested a lot in solar and wind. And what happens is it's not as reliable. And so now they're trying to ramp up, their existing fossil fuel plants with natural gas, because natural gas is, less emission when it comes to coal and oil. And that's what's driving up natural gas prices. And because of these initiatives, you're adding a lot of more costs, because energy is becoming more costly, because you're not choosing the cheap, dirty fossil fuels, but still unwilling to choose nuclear, which is obviously the much better alternative. So what happens is, you're increasing a lot of costs. And finally, global minimum tax. The push for global minimum tax is, so obviously some companies who have been paying a lower tax rate will experience a higher tax cost. But another part of that is compliance. The compliance costs, the need of hiring, more accountants to deal with this global minimum tax. And all this adds to cost of operating. Not only does it increase the barrier of entry for new companies, it increases costs for existing companies. And what happens is then you have, more pressure on prices. And now let's talk about transitory inflation. So yes, Jerome Powell is correct about some of the transitory factors with supply chain constraints, with a lot of plants being shut down because of COVID, trying to lock down. But what we're seeing now is the shipping container prices have come down, and when it comes to commodities, they have taken turns making new multi-year highs. And the reason for that is the cobweb theory, where the price increase, for example, like corn and wheat, I've talked about this before. If a farmer sees corn, wheat prices went up significantly, I can make a lot of money. So, but how do I secure that price? I go into the futures market. I sell a long-term contract at those prices, and it gets more and more near term, but I sell a long-term contract, and by doing so, you push down the price because there's more, the farmers are like, holy cow, this is so profitable. I'm just going to come in, sell a lot of futures to secure those prices. And with the cobweb theory is eventually supply catches up with the increase in demand. And so I agree with the global central banks with their idea of, inflationary. Some of them is transitory. However, they're ignoring the long-term impact of some of the structural inflationary factors. And that's why I think inflation won't get too high, but it will be there for the long term with stagflation. And it's annoying because it's not super high inflation, but it's always in the background. And once people realize this, there will be implications and obviously investment implications as well. Now let's talk about one of the hot topics, China cutting power. Now, a few potential reasons have been surfaced. First being high coal prices. It's just getting too costly, so the plants don't want to do it without, increasing prices. Another being the demand is returning quicker than supply. And what's happening is throughout the beginning of the year with, global shutdown continuing, but China's recovering the quickest. And so they restart their plants, they restart production. So when the rest of the world was shut down, China increased its production for goods. So if you actually take a look at US-China trade deficit, that's where you see China filling the gap. Where, for example, US, a lot of people are not working, but they still need to have consume goods, which is what led to the ship container crisis earlier in the year. But in order to supply those goods, the factories increased, usage, increased and energy usage, and that's what's causing the demand returning quicker than the supply, which is the power plants generation. And finally, the carbon emission quota. So China has carbon emission quota set for 2030, and maybe it's due to the overusage during the beginning months of the year. And now that there's only 3 months left to meet annual targets, maybe they're just trying to, like, the only way to do it is just, try to cut power. Like, for example, like in some provinces, any elevator or escalator for like first 3 floors are not usable at all. Like, they just cut it off. So you just have to take the stairs. And I think like another reason is like China, provides energy, like export it. But and the only way to really increase output based on, nuclear, wind, solar, hydro, and fossil fuel mainly is really nuclear or their coal plants. And with nuclear, they're just still working on it. Obviously, solar and wind, you can't just increase. Hydro, there's little control on that. It really depends on the water flow. And so it's really on coal. And so do they want to continue to have their citizens be impacted by, more carbon fuels in the air by burning coal, while other countries get like, cheaper energy, And finally, my implications, I'm expecting higher energy prices domestically and export, and potentially we'll see with some of the factories, if they're going to get shut down or reduce production, then there'll be export goods cut, which will lead to, higher import prices for other countries. Another hot topic recently is the US debt ceiling, and I think for now it's been left until December to be discussed because they mentioned that they have enough money until then. So, this will come up again. But what is it? It's a limit on national debt, but I don't think it includes off-balance sheet items such as state and federal pension plans, and other I think like student loan and maybe like government guarantee student loan is not part of it, even though like they're liable for it. So Janet Yellen, the Treasury Secretary, mentioned that they can't pay their bill if the limit is not raised. Well, isn't that hilarious? Like imagine you're telling your credit card company, hey, you need to increase my credit limit or else I can't pay you. I can't, make the credit card payment. Well, that just means like for the reason for that is because you're not paying your bills, because you're making the minimum payments only, but continue spending. So you're making the minimum payments on like interest, but you're still borrowing more and the interest cost is increasing. And so it's not because you can't pay the bill. It's because you don't pay your bills. That's why you need, higher credit limit. And, obviously she can't say that. And a lot of it really comes down to politics, where these politicians don't want to cut spending because that's how they get elected in the first place. You promise something for nothing. Hey, don't worry, government will buy it for you. And, just give me your vote. And so what's happening is, so obviously the Democrats have control of the House, but they have 50-50 in the Senate. And in order to pass a bill like this, they need 60 votes. That means they need 10 Republicans to sign on. Otherwise, they'll have to use the 1-year exception, where in last year, and this is based on fiscal year, so the US federal fiscal year is with October. So last year they used it for the last $1 trillion, like I forgot how much is it, but the last big spending bill. And this year, I think Biden administration is trying to save that 1-year exception for his infrastructure bill. And so they're hoping that the Republicans will sign on to raising the debt ceiling, and they can use that exception for their infrastructure bill, which will buy them votes for the midterm election coming up. And what's the implications? If the debt ceiling is lifted, which again, I expect it to, like it's only a matter of time, like they're just playing with different bargaining chips. I think Powell's election or renomination is part of this, where the Democrats are like, hey, Jerome Powell is a Republican Fed chairman, like I will promise to like renominate him, and you guys help us, continue increasing the debt ceiling. And if this debt ceiling is lifted, like for example, like not just increased, but like completely removed, that's another constraint removed from government spending. And that has, severe implication on both inflation and also flow of capital. And if it's not just increased, but if it's removed completely, then the impact on the rate of increase of currency and capital, the total reserve, and liquidity is to be observed. I'm not sure. It's kind of hard to kind of forecast, but we'll see how it goes. I do expect it to be passed because this is just politics. They're just trying to get their different chips in line for the midterm election. I think the Democrats will try to save the exception so they can get more votes, and the Republicans are trying to, whatever they're trying to do. I have no idea. And Jerome Powell's nomination might be one of the bargaining chips. Now let's talk about the opposing mindsets in the different central banks. So in US and the EU, they continue to maintain zero negative rates, continue easing policies, and the US now is trying to move, and US and EU now moving on to currency policies. US want a stronger dollar because that will reduce the impact of inflation. on US dollar terms, and EU is continuing weakening their currency, and US really missed their opportunity to tighten when economy data was coming, like from the rebound was coming good, because now what we're seeing is unemployment rates are increasing again, and the PMI is coming down. And so what happened is when times were good, they kept easing and they missed their opportunity to tighten. And now that we're seeing economy turning back down because of the overspending from before, now if they try to tighten, they will crash the whole thing. And so that's kind of why I expect any of this taper talk will eventually be reversed. Emerging markets, however, have a different kind of mindset. They've been raising interest rates, tightening monetary policy. Now, a part of this could probably just due to inflation, like Brazil have dealt with it, and Turkey, and also protect the value of their currency. And another thing is to avoid the outflow of capital. And so what we've seen in the past is US will be easing, so shipping money, and money flows out to different parts of the world and inflating everyone's asset prices. And because other central banks follow suit, we see massive financial asset inflation. And then what happens is US become the first one to tighten monetary policy, to raise interest rates, and that sucks liquidity away from different part of the world. And what happens is it crashes their financial markets. And then, investors have no choice to keep their money in US dollar. And so even if US financial markets comes down, it doesn't come down as much as emerging markets because, they suck the liquidity away from them. And so I think emerging markets, especially, China learned it, to not allow that to happen. And when US continue easing, China is tightening. And so all the easy money flow into China, which helps support its, corporate high yield bond market. So even though that the corporate bond market, like default rates were very high, but they're still, because the yields were high enough after default rate comparing to the bonds in other countries, that people were still willing to buy up the US defaulting corporate bonds, which provided a great cushion for China's market. So implications, really this is looking at the global flow of capital, where with these opposing mindsets going forward, what will happen with the flow of capital? And you kind of want to follow that, right? Honestly, like it's a great news for possibly us. Not sure on your perspective, but like I don't have much money, so this is great for I don't have much investment, so this is great for me because then I can kind of follow the capital where I don't have big establishment, I don't have big companies, so that doesn't impact me. It's a good opportunity for me. Now let's take a look at market updates. So looking at the bond market, there's a rapid increase in US Treasury yields as expected, and this is because the real rates are rising, which is led by nominal yields. And I think one of the reasons is a lot of the bondholders anticipating Fed tapering, meaning if they're going to sell bonds, you want to front run that, because if Fed sells bonds before you do, then your bonds don't worth as much. So you want to sell your bonds before the Fed sells theirs. And where they're parking this money, not equities market, because the overnight RRP continues to make new high, because I think this is another indication that you need to be careful in the equities market. Now with equities market, with rates increasing, valuations are coming down, and also with liquidity not going into markets, So obviously growth stocks are impacted the most. So we've seen NASDAQ come down the most comparing to other indices. And I would not trust this US rebound for like the past like half of this week. Wait one more week to kind of see if this is a dead cat bounce before further downside. Meaning, because until the Fed comes out and removes any tapering talks, I think this, October is going to be very choppy, and maybe we'll see more 2020 March style correction. And finally, currency market. So euro is moving lower with the ECB's policy, and the DXY US dollar index could peak. So I think it's right now 33, 34, and I think it could peak around like 97. Sorry, yeah, 93, 94. I think it could peak by 97, 98 before the Fed has to come in and kind of reverse course, remove the taper talk, and then maybe the DXY will move lower then. We'll kind of have to see. Finally, let's take a look at commodities updates. So precious metals obviously moving lower as expected with real rates rebound. Again, I think this is happening in the short run. And then for the long run, I think once the last flush is out with equities moving lower, like the week longs, and then we can see the rebound. And the signal is really when Fed starts cutting taper talks and return to easing, then I think the next big rally will begin. With equities, however, I think a lot of investors have been flushed out. And that's kind of why you see the equities are near, like a lot of it is near 52-week low and continues to make new 52-week low. Well, the underlying metals aren't actually not at their 52-week low. So I think a lot of opportunity are in the equities, but there's still short-term further downside risk. But I think like these price levels are quite attractive. Finally, energy. Brent crude almost touched $80. I do expect it to do so in the future. And with along with natural gas as winter approaches, and I think it might be a pretty cold one, I do expect continued strength in the energy sector. Uranium equities might have flushed out some of the week longs. We'll kind of have to see. Like for example, like Chemical has rebounded somewhat, but again, I think long-term, like long-term perspective wise, great investment and opportunity. I think uranium has to hit up to at least like $80 because it will overshoot. I've talked about this before, but thanks for watching.